Equity and bond markets saw reasonably large swings during the quarter, but many indices ended the period close to where they started. April and May broadly saw equities continuing to rise in value while bonds fell, but the second half of June brought a sharp rise in volatility and a reversal of these trends. Against this backdrop, most of the Harmony funds performed well in April and May, extending what had already been a strong start to the year, but then posted declines in June. The overall result was a reasonably wide range of returns across the various funds over the quarter, with several of the funds posting declines. Nonetheless, performance for all the funds compares favourably to most peers with comparable currency and risk profiles, as well as to representative combinations of equity and bond index returns for each region. The Asian Balance and Asian Growth portfolios performed best, gaining 0.7% and 0.9% respectively, while the US dollar portfolios posted small gains. The Europe Diversified Fund fell 0.9%, but the Australian dollar and sterling portfolios experienced greater falls of around 2 to 3% in local currency terms. Despite being a difficult period for some of the funds, they all remain in positive territory year to date, net of all fees. Most have delivered low single-digit returns in their base currencies, except the Australian dollar and euro portfolios, which have delivered larger gains of 4.9% and 9.8% respectively. Key market drivers over the quarter included a modest gain for global equities, sharply rising yields on developed market government bonds, and a pause in the recent trend towards dollar strength. Considering equities first, the Japanese market outperformed with a 5.8% gain, while US and Asian markets also rose slightly. Meanwhile, having gained 7% in April alone, broader emerging markets only just ended the period in positive territory, with a 0.7% gain in US dollar terms, after falls in May and June. Meanwhile, the UK market fell 3%, driven by weak performance from several of the large-cap mining and pharmaceutical businesses that dominate this market. The Europe ex-UK and Australian markets proved laggards, with falls of around 4% and 6% respectively. However, Europe remains among the better performing markets year to date, with a 14% rise, only bettered amongst major markets by Japan's 17% rise. Overall, global equities posted a marginal gain of just 0.3% in US dollar terms for the quarter. Meanwhile, government bond yields rose for most countries. The moves were reasonably large, 40 basis points or so on 10-year bonds in the US and UK, and higher elsewhere, resulting in losses for holders. In Germany, the Bund yield almost quadrupled from 0.18% to 0.76%. This resulted in meaningful declines for bond indices, of as much as 5.4% in the case of European sovereign bonds. We continue to have little to no exposure to developed market government bonds across the Harmony funds, but these moves did have implications for other interest rate sensitive investments we hold, such as the listed real estate and infrastructure sectors, which underperformed broader equity markets as a result. The areas of fixed income markets that we do have exposure to weathered this period of rising rates well, with US high yield and global convertible bonds both roughly flat for the period. Both our asset allocation and manager selection decisions contributed meaningfully to performance of all the funds during the second quarter of 2015. Across most of the funds, key factors driving the contribution from asset allocation included our overweight towards equities, high yield, and convertible bonds. Of particular benefit were our Asia convertible bond holdings, represented across all of the funds. We also benefited from having little to no exposure to government and investment-grade bonds, as well as our reduced allocation towards listed real estate, decisions that all helped to preserve capital. Our positioning within our equity holdings also contributed to performance, for example being overweight Japan and emerging markets. Manager selection was a smaller contributor to returns over the quarter, but still had a positive effect across all of the portfolios, driven mostly by our equity holdings. We were reasonably active during the quarter, implementing various small changes to both asset allocation and manager selection across the funds. There were two main asset allocation changes. Firstly, towards the end of April, we reduced our emerging market equity and Asia convertible bond holdings, following very strong returns of almost 10% in US dollar terms in just a month. Valuations in these areas still look attractive, so they remain well represented in the portfolios. But we felt it was prudent to marginally reduce the risk contribution from these areas in favour of slightly higher cash levels. Then, towards the end of the quarter, we sold our holdings in Polar Japan equity across most of the funds, following gains of around 30% over the last year, representing significant outperformance versus the flat US dollar return from global equities over the same period. We maintained the same overall equity allocation, though, by adding to the Crux European Special Situations Fund, run by a manager that we have invested with for many years in the European Harmony Fund. This decision followed a period of underperformance for European equities, driven by the ongoing Greek debt crisis, which we believe presented an attractive buying opportunity. We also made 3 small changes to our manager selection during the quarter. The inclusion of the Sands, Westwood and 24 funds represent positive changes that are the product of our team's detailed and wide-reaching research process. We believe these additions improve the performance potential of the funds, whilst also improving style balance and diversification. Despite these small changes, the overall positioning of the funds remains similar. We hold meaningful allocations to a diverse range of high-quality equity strategies across various regions and sectors, balanced with listed real estate and infrastructure holdings, as well as fixed income holdings across credit, convertible, and emerging market bonds.